I missed that, to be honest. No, I don't. Well, there has been there was some things, some redemptions and stuff going on, but that was last week, wasn't it?
Yeah.
Last week, I think. Yeah.
Yeah. Well, that was a Bloomberg headline. So
they've been selling a lot of U.S. treasuries as well, and but that should not put their own yields to go higher. I really missed that one.
Yeah, well, the gist of the story was more so that a lot of Chinese are getting out of bonds and into stocks, maybe on the COVID reopening situation, but it has caught a bit of a liquidity trap, caused a little bit of liquidity trap in Chinese bond markets. Hence why that headline has been produced. As we can see from the moves in the yuan, up above 716, nice. That kicked off this morning with that headline. So, you know, a little bit of a move there, and it's continued on. So something just to keep an eye on, whether it's Bloomberg spinning up a headline or not, will have to be seen. But dollar is looking pretty strong secondary this morning. So that's given it an extra boost today. But we'll keep an eye if there is any big problems there. Australia was out with some data overnight, jobs data. On the whole, pretty good, pretty decent. Employment change was up 32k versus 15k expected. The unemployment rate fell to 3.4% from 3.5%. But that may have been in part due to the participation rate dropping a pip to 66.5%. Either way, jobs market looking a bit more solid in Australia. They're obviously looking at wages and the like to see whether there's going to be further inflation pressures. The RBA pretty much on the fence regarding sizes of hikes. They may go bigger, they may not, they may stick to 25s, but they're going to continue to hike. We'll see whether further data pushes them more towards 50 pips than 25s at the moment. In Japan, they're going to jump or raise their COVID alert level by 1 notch due to higher cases. As mentioned earlier in this week, they had exceeded 100k cases again for the first time in a few months. So they're getting their alert level up a bit. We had Kuroda out with his usual waffle. We also had Bank of Japan's, if I get his name right, Uchida, saying it's too early to discuss exit from monetary stimulus, and a rate hike before balance sheet adjustment is possible in an exit. So that was the comments out of there. We also had, I don't know if you caught it, Kate, apparently some comments from an ex-deputy governor who's potentially in the running for replacing Kuroda.
Yeah, Nakaso. He's BOJ, and he's now at the Daiwa Institute of Research, and he has written a book earlier this year. He's pro moving away from the ultra loose monetary policy, and himself and Amamiya, who's currently the deputy, I think, in Kuroda's deputy, they seem to be the major front runners to take over from Kuroda. So yeah, he came out with those comments, but then at the same time, Kuroda and a couple of his mates were saying that no, it's not time to get out of it yet, and just go on.
Yeah, I mean, he was saying that the BOJ and central banks in general need to remove the emergency support measures. So not a wholesale act of tightening, but at least removal of emergency measures. Whether he's setting his stall out ahead of potentially replacing Kuroda remains to be seen. But probably one former person that we actually need to pay attention to. Sorry?
The interesting thing about Nakaso, that he was talking in Bangkok, and he traveled with Kishida, Prime Minister Kishida. So Bank of Japan watchers are trying to put one and one together and saying like, oh, right, he's probably a person that Kishida will be listening to going forward. So that's the link that people made in regards to these comments, right?
Yeah, exactly, mate. Right, I'm going to move over to the ECB. Villeroy was out with his usual stuff that big hikes are not going to become habit. He also said that rates are likely at the normal range near 2%, or will be likely at the near range 2% in December. Hikes beyond 2% will possibly be less rapid. So he wants the cautious approach and the slowing down approach. ECB's costs said the inflation spike is proving highly persistent and has also broadened. That's a big no-no for the ECB. That we still have some way to go with rate hikes, but the specific level that interest rates may have to reach to be consistent with this objective is uncertain. So how high rates may have to go is uncertain. There's no real rate ceiling being priced by these guys at the moment, as opposed to the Fed. There has been some other newswire rumours coming out that ECB officials may favour a 50 pip hike in December versus 75. It wouldn't be that great a shock if they go 50 BPs. Enough of them were saying 75 pips at the last meeting, 50 at this one. That's not the first time this particular newswire has pumped this headline in the last week or so. So they're trying to get some drum up some interest there. Just checking the rate odds this morning for the ECB just to see where we're at. The market favours, or the odds favour, a 62.3% probability for a 50 pip hike at the December meeting. The balance 37.7% for a 75 pip hike. These numbers are always important going into the meeting, where we are into the meeting, because that gives us where the greater risk lies. So the market's looking for 50 pips more than 75. So if they go 75, it'll be a bigger shock to the market than just delivering the 50 pip as expected. Over to the good old Bank of England. They're going to be in focus after today's events with Hunt. There were some parliamentary appearances in certain committees. And Bailey came out saying QE hasn't made a very big contribution to the UK inflation overshoot. And he sees a pronounced fall in inflation beyond the winter, but still likely they're going to have to raise rates further. My thoughts of that have been pretty clear from the off. They're probably going to get rates up higher than even they expect. Inflation came out yesterday, much higher on the headline, matching on the core. We'll look at that in a moment. No reason that we've peaked in inflation yet in the UK, and likely we're going to continue going higher. BAE's Dingler said they could get into a much deeper recession if rates continue to rise. So worried about how high rates will impact the economy. And there is now a risk of over tightening. Okay, whatever, 11.1% inflation. Explain to me how you're going to over tighten in that situation. But there we go. Fed's Daily says the consumer is hanging in there after yesterday's retail sales report, and is preparing for a slower economy. The Fed wants to see the economy slow to get inflation down. It still strikes me as absolutely crazy that a central bank is actively trying to get the economy going in reverse, just to combat inflation. Their whole job is to help the economy, and they want to destroy it effectively, or at least lower activity. It's still a bonkers world we live in, hearing that from a central banker.
Ryan, it's amazing because that's how things used to work, and in theory that's the right thing to do. But what we're seeing now is inflation, not because everything is nice and dandy and people are just buying everything left, right, and center. Inflation's gone up for completely different reasons, and they're using the only instrument they know how to use. And it's, I think you're absolutely right. It makes no sense to try to kill your economy to get inflation down, but that will make sense only if things were so good that you're like, okay, we need to cool down this really, really good buoyant economy. But that's all they've got, and that's a problem. Do they sit by idly looking at inflation over 10% doing nothing? They're going to get a lot of stick for not doing that, not doing anything. So they kind of have to take this destructive action, which is a bit crazy. But I don't see what else they can do. That's a problem.
No, that's painted into a corner as usual.
Bailey said as much yesterday on the parliamentary committee, in front of the parliamentary committee as well. He said it too, and that's I was a little surprised actually to see Sterling gaining after him, but that must be ahead of the budget. But he said as much as well when he was talking to the Parliament's committee yesterday, that they have to slow down the economy to get inflation down as well.
Yeah, it's bonkers. They would have a case if GDP is running sort of 4 to 6%. You got some room to manoeuvre. Here, we're already circling the recession drain. They've got no room to manoeuvre. So
somewhere I understand that the Americans are saying it. Okay, some things are cooling down. Let's put it that way, and showing signs of. But they can still talk the way they talk because of their. The jobs market is still holding up, and the U.S. economy is historically a bit more dynamic than other economies. But I didn't really get why Bailey was bringing that up yesterday.
Yeah, well, they're sent out to confuse us at the best of times. But going back to Daly, she said pausing is off the table and not part of the discussion, and focus is now on the level of rates. She wrote down 5% as an ending place for rates in September and still thinks 5% is reasonable, i.e. the ceiling where rates will go, and thinks that a range of 4.75 to 5.25% is a reasonable end point for the policy rate. That pretty much mirrors what Powell said at the FOMC when he had his little hawkish twist, saying that the ceiling may go higher than expected. At the moment, the ceiling is around 5%, according to Fed dots. So we are still expecting those to move higher at the December FOMC. I think it's December FOMC. We get the fresh projections. But anyway, how high they move and how many people move their ceiling higher is going to be what moves markets potentially at that meeting. 5.25 might become the new low point for the ceiling. It might move 5.25 to 5.75, 6%, something like that. So the rate of that ceiling moving is going to be the most important part of the next FOMC when we get the next projections. Fed's Waller, and I don't know why, he's suddenly become the go-to man for laying down Fed policy. He was out again saying that the higher the policy rate, the stronger the case for slowing to 50 pip hikes. So favour of a slowing. On recent data, says it's made him more comfortable with the idea of a 50 pip hike in deck, but going to watch the data between now and December before deciding on the next policy step. Also says they still have a way to go on rates and will need to hike into next year, and that they'll reach the terminal rate well before inflation reaches 2%. On the data itself, it welcomes the moderation in CPI, but will not be head-faked by one report. And the Fed wants the markets to focus on the endpoint for rates. Again, the ceiling number there. Why has Waller suddenly become the go-to man for comments, Kay?
Yeah, he's been the hawk since when he started. Him and Bullard, I call them Stadler and Waldorf. So Bullard will be Stadler and Wally will be Waldorf. So he's a hawk. He's really at the extreme of the spectrum. Did he say something about 5.25 as well? And I may have.
I don't know. I may have missed that.
Mixed him up with somebody else, but it does seem that he was. I mean to remember yesterday or the day before he said something about 5.25 as well. it looks as if that's where we are going. By the way, dollar China is still flying. I took profit on what I had right here.
Yeah, I'm just looking at that.
See what happened.
I might have a little
see what happened later, but the dollar is regaining some strength here.
Yeah, definitely. I might have to pause and have a little cut. I might do that when you're doing your little chart roundup, Kay.
Yeah.
But decent area we're getting into. Just to look over some of the data from yesterday. Obviously, Kay would have covered all this in yesterday's show, but there's the UK CPI rocketing up. No end in sight there for peak inflation. Coming down to retail sales, pretty decent numbers on the face of it, but we still have this, not adjusted for inflation stuff going on there. But based on just the headlines, we're seeing decent numbers. We're not seeing any big negative numbers going on there in retail sales. So the US consumer doesn't look to be overly struggling. Although, as we say, if you take into account inflation, they could just be paying more for the same stuff rather than any sort of increases in spending. But on the whole, not looking too bad. Was there any propel heads coming out on those retails, Kay? With
I haven't seen any
real sales. No. The NBA numbers may be reflecting what we've seen since CPI, and obviously the drop in yields and the expectation for Fed rates, where we've finally seen a bit of a dip in the 30-year mortgage rate to 6.9% from 7.14%. Applications, a surprising jump there, 2.7%. Probably likely more dead cat bounce than anything that says the market is turning around in housing. We get more housing data today, starts and permits. Bank of Canada, or rather Canada, was out with CPI numbers as well. And depending on what number you want to look at, no real moderation coming in from those numbers. One core measure did show a little bit of a pullback to 5.8% in the core, but the rest of the numbers pretty much as last month, if not a touch higher. So no signs of inflation easing just yet over there. US industrial production, a little bit down. Capacity utilization dropping a bit there. That's the if you like, a percentage of how active or manufacturing firms are, how their capacity to produce goods. So a little bit of a dip there. It's better if the capacity moves high. It means that a lot more is being used and a lot more being produced. So a little bit of a dip there might be reflected of what we've seen in some of the ISMs with production falling in the manufacturing. So that's a bit of a lagging data there, though, for that one. Another housing market index, the NHAB, which has been an absolute dive, lower again, 33, missing expectations and much lower than the month before. So, as mentioned, no real let up in the housing market there. And as mentioned, we get more of that data today. Over in Japan, trade balance data, all over the shop once again. Exports, I mean, these numbers are still crazy, 25% lower and missing expectations. For exports, imports 53%, 53.5% beating expectations and last month. It's still not really easy to get a handle on that economic side, is it, Kay?
No, and as mentioned yesterday, industrial production was also lower, and they still they look like to be in a yo-yo situation now with their data, and then they were improving a little bit, and I'm starting to wonder whether it's been because of those let's call it repatriation or treasury selling and stimulus and whatever, that they showed some better numbers, and then now the thing is done, and I don't know whether Japan is out of the woods or not. It's just, I don't know. I'm not going to call it really. If you look at the yen, it's more moving with U.S. interest rates than really anything else right now. The data again, as we've seen, bad data this morning. We printed a low again on the dollar yen because the early morning The early morning flows in Europe have always been dollar buyer the past week. So I don't know whether they're really very tradable. I'm not sure, but at least it shows that Japan is by far not out of the woods yet.
Yeah, definitely, mate. Definitely. Right, give me a second. I need to close off some of my dollar one. There we go. Done.
Yeah, I'm out.
Yeah, into the Eurozone. Final CPI numbers, no real change there. So just confirming the, well, I say no real change. It dropped a pip on the headline number. No big deal, still running above 10% for CPI. The core number unchanged on the flash number at 5%. So still heading hot there. As mentioned, we do have housing starts and permits, as well as Fed manufacturing. So we'll see if there's a bounce there like we saw in the Empire State earlier this week. Obviously, jobless claims, keep an eye on if we get any major changes there with regards to the jobs market. Let's have a quick look. Anything later on? Note some minor manufacturing data there from some of the regional banks. Okay, let's get stuck into the prices, and let's start here with this dollar one. So those who may have been watching on the in the ForexAnalytix chat room, I know Kay was dipping in. I dipped in here the other day. 706s, picked up some more 704s. Yeah, a lot of dollar strength. We had this kicker as well from the Bloomberg headline. We're into a bit of a zone here now. 716, 717 is a bit of a level all on its own, but then it forms part of this zone up here, up to 17, 19 and a half, 17, 20, whatever you want to call it. If we can't break back above through this zone here, then likely we might see us ranging a bit, maybe back towards the low sevens. This down here is beginning to look like where the protection of the big seven is sitting. We've had a couple of attempts now, a few attempts now to get down there, and it's held, a couple hundred pips above. So that, I think that's where the buyers are sitting in protection of this seven level. Could mean that if we do get down there, we're potentially setting up for a break. And if we get a break, it could be quite significant. Maybe down to the 6.95s pretty quickly, or at least to that fib level down there. So keep an eye on that one. I've just chopped a bit more off my long. If we get through above 717, I'll start ramping my stop up quite significantly. Another one I'm looking at, or I've been long, gold, as you may know, continue to fail up at this 38.2 fib in the 1780s. I expected if that were to happen, we'd pull back to the 1750-60 area, which we've done. From here, it's a bit of a binary event. Can we retest the highs and break them, or are we going to break through 50s and then see a steeper pullback down to the low 1700s? At least this 1720, 25 area is the next area to watch down here for me. Might see it coming in around 1730s. This is looking typically like a pause when you get a decent rally. I mean, it's obviously, you can see the strength of this rally here. They don't all go on forever. It goes back to what I like to try and teach traders is when you're trying to pick tops and pick bottoms, you want to see a period where an area is holding more so than this sort of price action and this sort of price action. So we've had this definitive top put in place now. We've had a few attempts to try and push it up. It hasn't. You're always going to get a pullback. Where does it pull back to? Well, then you try and pick your spots where the next support zones are. This was one that's gone back quite a while, 50s, 60s. So this was an area I'm looking at. If we hold there, then as I say, we should get a retest higher. If not, then likely we break and we come back lower, and then you've got to look at your next levels. Same, looking at that with another position. I'm in Aussie dollar longs. Where's it gone? There it is. So pretty similar story going on here. Got up to a high, nice big rally. Can't break the highs. Can't get above the 68 area. There's bigger traffic, 68.50s. So this is the significant area for now. If you're not going to go up, there's only one other way you're going to go down. This is the support zone that could be important now. 60s, 80s, 66, 60, 80. If we get through here, we're probably going to visit 66s fairly quickly, maybe even worse. The ultimate zone still remains down that 65, 20, 40 area that marked the big breakthrough. So that could mean we create a bigger range between there and 68s for the longer term. That's an area I'll potentially look to add back into my longs if we get down there. I didn't ask you guys, you had any other headlines? Sorry, Stel, you got anything you wanted to add, or any charts you want to look at?
Don't have anything to add in terms of headlines. You've pretty much said it all. I mean, the main thing that we have to keep in the back of our minds now, but more of a general comment, is that the market's now trying to place a top in rates for the major central banks. And if you look at Fed fund futures, we're pricing below 5% for the Fed, something like 493 or whatever. So this is this is something that the market's now kind of playing chicken with the with the central banks, and we are seeing central banks changing the tune a little bit, even in the Fed. Lael Brainerd was on the dovish side. Now ECB are telling us that 50 is more likely. Bank of England also are telling us that the likely peak in rates is going to be not a lot higher, etc., etc. So this is a tug of war that we're playing now, and it's dangerous. It's dangerous because if inflation persists, you can be pretty sure that the central banks are going to keep going. So you're taking a view on inflation if you think rates have peaked. But yeah, I mean, it's a delicate situation, and that's why every number that we're seeing now, every kind of important data point, is more important than it used to be. You have to be nimble, and you have to have your levels, like you say, and you have to be clear with yourself that if you're running positions through a big number, you're taking effectively a gamble on the number. So it's anyway, just some thoughts I keep having, and I know I repeat myself many times, but it's nice to have an idea of what's happening in the big picture before you look at the specific levels and more short-term trades, etc. But no, otherwise I don't have much to say. I mean, I can show a few charts if you want, but
Sure.
I don't have anything to add.
I just wanted to point out one thing, and then you can jump in, and then we'll pass it to Kay. I can't remember if it was Monday or early Tuesday. I wrote in our chat room, following all this move down in dollar yen, that there was a potential to make a new low. I was interested to see if we tested these lows on bad data, and I wrote that we could get another shove, but what will be interesting is if we get a quick reverse on such a move, and that's exactly what happened on this. And why it's important is because despite getting that bad PPI data, which caused this little knockdown, we sprung back pretty quickly, and then these old levels start to hold again. That gives you the signal that we found a bottom, potentially, be it short term or otherwise. That means that bad data from here, depending on what it is unlikely to have a significant move lower. I.e., we're not likely to see us, going down to 135s, 134s, at least for now. Now, obviously, things like NFP and ISMs and the big data points, they can obviously cause ructions. And if we see the NFP tipping over, that is likely to cause another leg down in the dollar. But maybe some of the smaller reports, like the housing numbers, the PMIs, that sort of thing, it potentially says that the market has now got itself in a comfortable position. So as far as the sellers from up here are concerned, they've had their pushes, they've tried again, and the buyers have gone, no, that's enough. That's all we're giving you now. You've had your way. This is now our turn. Doesn't mean we're going to be shooting all the way back up again. It just means that perhaps we're going to find a bit of a range to sit in. This 140, 65, 70 area is going to be the place to watch. But for now, from the move from all this 146s, we've stopped. And that's important. So if you see bad data, doesn't mean pile into shorts because we're going to get a 137. You've got to recognize this area, this price action around this area now, because it's proving to be solid. It's happening over a decent amount of time now, and that's what you want to look for if you're trying to pick the bottoms. As Kay said, we got a sell off this morning, dipped under 139. It's happened for the last few mornings. In the UK morning, we've seen a sell off, Mr. 8 a.m. man, we called him, but we've sprung back strongly afterwards. So keep an eye on that. The price action is key for this as to whether the market is willing to push it further south or it's had enough for the moment. And with that, Stel, I shall hand it over to you first.
Yes, sir. I'm taking the screen.
Got it.
Okay, so I'm going to just reiterate a few things I've said in the past. Nothing major has changed, but my view is not a 24-hour view or a weekly view. I always look at the bigger picture. So I always start with yields. 10-year US has dropped quite a bit. There is we're heading to a few levels of interest here. So there's a 38.2 fibs, 364. There's also these lows down here at 55. Very close to these previous highs at 50. So between 50 and 64, I think that's a pretty decent area where I think we'll find support if we haven't found it already. But I really think that we're probably going to grind a little bit lower to those levels. Now, we have the next Fed meeting on the 3rd of December, if I'm not mistaken. Oh, actually, no.
It's only on the 14th.
14th, no, sorry, it was the 3rd of
think...
November. It was the 3rd of November this month, and it's the 14th, 15th, right? Or something like that. Okay, so we still have just under a month until the next meeting. And that's when the Fed is going to give us a very good idea of which way we're going. But until then, we have almost a month. So a lot of things can happen. As I said before, I think this range around here is going to be a nice support if anybody wants to take a counter view to this this drop from the 433 high. But at the moment, yields are weak. So that is also driving the dollar lower. We've seen that. We are heading towards the 200 DMA. Yep. And, I think this is, I think both the yields and the dollar are going to head toward those levels. So yields where I showed before, the dollar towards 105. And then it's going to be a big decision which way we go. But I think we continue to grind a little bit. And that means that risk probably continues to get bid. I mean, if yields stay weak and the dollar also weakens, which I think is the most likely scenario, the S&P is probably going to rally a little bit, and a move towards 4,100. Let's drag that line a little bit further. So this trend line here is probably going to be around 40.50 to 4,100. Remember, 4,100 was a pretty big level, low there, low high here. It's something that a lot of people are looking at. So if you want to be short equities, I think that area is probably not a bad one in terms of risk reward. Again, any trade I personally take, I try. I want to be very disciplined with my stops and make sure the trade doesn't go too far away from me. But yeah, I think the risk is that we grind a little bit higher in equities, we grind a bit lower in yields in the dollar. The DAX is, let me move this a little bit further. DAX is at an interesting point, but I think that also has a risk. I mean, these are all correlated, right? Effectively, it's one trade. Everything is one trade. That's how it's become. But, with ECB telling us that it's more likely that we're going to get smaller rate hikes going forward, that's going to give a little bit of support to equity. So I think the DAX has a good chance of getting towards that 14.8 level again, at which point, look at these lows here, 1, 2, 3, 4, 5, 6, and then a high. I mean, this is a very, very big level around 14.8, 14.9. So just another thing to look at. I don't think we're there yet in any of these instruments to take a trade, but we are getting there. And talking about risk, the king of risk. Cryptos are not doing well, obviously, due to the FTX thing. And now we had yesterday the what they call Genesis also stopping withdrawals, and they are apparently massive. I don't know much about the crypto space, but from what I read, this is there's a lot of cross holdings, and you can bet the farm that it's not, you know, when such an incident happens on one big exchange, you can bet that there's going to be contagion. I mean, that's the way markets are, and I think that's the way markets are ×2 in cryptos. So this is looking weak. Remember, we're talking about this consolidation here in Bitcoin around 18 to 20K for a while, and we said, look, the more it lingers here, the more likely it is it breaks down. Well, we broke down, and we are now doing something like, you know, something like that. I don't know, some kind of, it looks bearish again, right? It does look bearish. Now, obviously, we could, if we do get a risk on move overall, cryptos are probably going to be taken with it, but it just doesn't look good. You know, there's no bounce from this 2-day. This was a really strong 2-day downward move. Again, though, we are above the highs, above the lows, 15.6, wherever that was. So that's your support. If you want to play it on the long side, you have to be very careful. You know, placing a stop below there doesn't mean you're going to get filled there. You have to remember that. It's not a level, oh, my downside is, you know, $100. It could be 500. You never know. So you have to be very careful with that. Ethereum is a similar story, slightly better than Bitcoin, but it's now coming up towards these, well, first of all, these lows here, 11.10 or 11.11, where was it? And then the other ones. But overall, the crypto space doesn't look good in you know, anyway. The euro dollar is interesting. It broke out from this descending channel, came right up to the 200 DMA and retreated. So, you know, it's been trading quite technically. I don't know what to do with the euro at the moment. I really don't. So I would like to get long, but on a pullback, maybe towards 101. But that's quite a distance from here. Cable has been doing well as well. Oh, so lots of alarms here. Somebody said those. Cable is doing well. It had done particularly badly when the whole Liz Truss Kwarteng saga happened, and but still, you know, it's not convincing by any means, not yet. Europound is something I like to look at all the time. We are still, hold on, let me get rid of that. Stop. Okay, let me move those a little bit. We're still in no man's land, right in the middle of the 83 to 90 range. So I wouldn't touch that either. You know, it's I want to get interested above 90. I want to sell that above 90 if we get that there again. Another interesting one is USD MEX. We've been talking about that for a while. It broke below that 41 low, and now it's coming right back at it. This looks like the classic break and retest. Wait and see. But if we do, you know, if we do move lower from here, I'm definitely going to take a short. You know, if we look like we're going to be taking out these lows, I'm going to take a short with a stop above, because I think the next level is really in the 1850s, 1860s, and that's percentage wise, it's pretty big. So I mean, look at this. This has been testing this area here quite a few times, and it looks like we're breaking. Just need final confirmation, and if that's the case, then I'm going to definitely take a trade on that. Otherwise, not much more to say, really. Norway, I've been looking at. I missed it. I was talking about this for ages. I said, you know, a few weeks back, if we get anywhere near 50, 60, 1050, 1060, I want to short. We got there, and I don't know what I was doing. Maybe I was asleep or something, but asleep at the wheel. But I missed that. And
we're actually back testing that red line right now.
Yes, you are absolutely right.
Yeah, we're testing it right now. Yeah. Do you want to have a look quick at your metals, or?
Yeah. I'll have a look at metals, of course. Forgot about that.
Yeah, maybe you can do that. And then Ryan, I suggest we move over to the budget, because I'm looking at the clock.
Yes.
Yeah,
okay.
Definitely.
And you just take over.
So metals, I have been constructive. Yes, we are correcting today. Not sure why, because the dollar, okay, dollar strengthening a little bit, but yields are not doing much. But, you know, after this move, there's always going to be a correction. This is quite, you know, I've drawn this zone for a while and we got into it and straight back below. I think a drop towards 1730 would be a really nice level to retest and get long again. But at the moment, we seem to be retreating a little bit. Silver is disappointing. You know, it gets crushed quite often on very little evidence. But anyway, you know, we broke out of this channel. We're right back down. 2065 for me is the level to test. If we get, I am long at the money here, slightly positive, but really at the money. If we break below 65, I'm going to take it off and I'm going to reconsider. But all this obviously is going to depend on the Fed and you know, on what they tell us regarding their future path of rates. Okay, that's it. I'm done. So I'll go back to you.
Just a quick cue. Still, on dollar MEX, would you take this dollar MEX trade even if dollar was going up?
If the dollar itself was rallying, yes, but on a smaller size. Yes, cool. I like it as a technical breakdown, but if the dollar was rallying across the board, I would be very, very cautious and do it at much smaller size.
And me personally, if the dollar were rallying, perhaps looking at crosses is an option.
Yeah, instead of dollar MEX, looking at Euromex. Yeah. That's a good idea, actually. That's a very good idea.
One MEX yen, but then I haven't seen or done anything in MEX yen, so my chart is not even updated. Okay. I just want to quickly reply to Austin. Did you cover the liquidity in the U.S. Treasury market? Yeah, we heard Barr talking about it. You have to know that Barr is the head of supervision in the Fed, so it's normal that he talks about it. But he did put us a bit on. He did put out a bit of a warning, saying that with the hikes, with the slowing economy, with the tighter financial conditions, we have to be careful about the liquidity in the financial system. For the time being, though, I mean, it's his job to monitor that, and it's his job to warn with all the different factors. But there is nothing really new in that. The market already itself has been talking about this liquidity from nearly the day the Fed started to tighten, and a bit of panic, not really panic, but comments about liquidity on and due to QT and all those kind of things. But then the rest of the liquidity has really been accelerated by Japan and China selling US Treasuries over the past month. So we monitor, but I don't think it's a real cause for panic now, because the market is being pretty well prepared, I'd say, by Powell and consorts. We get so many comments that they could stay high for longer, that the market should be preparing. And if the market is not preparing itself for it, and I mean the market, not us, but I mean the big money funds, the central banks, the big money managers, if they don't prepare for it, that I think is in a way their problem. The Fed will have been sending out all those warning signals. So if there's a problem in the US Treasury market, Yellen has already also said that they might do a little bit of a tweak or a tweet. I don't know. I don't recall the name. In what they would do with their that there's a possible bit of treasury buyback. So they all are aware of it. They all comment on it, put the market in guard. I don't think we are at a point of something is breaking yet. So and please now, Ryan, just go on for the budget.
Yeah, thanks, mate. Right, so this autumn statement has been built up into a huge, massive thing for months. First things first, okay. We know probably 90% of what's coming out, maybe even more. As is the case with these things, it gets leaked, it comes out, what the tax cuts are going to be, that sort of thing. For trading it, the finer details aren't really going to matter. Whether the minimum wage goes up, whether national insurance is changed, for probably 90% of you who are going to be watching it, the details don't matter. What matters is the market's interpretation of it. Now, as with a lot of these political things, particularly in the UK, there's a lot of stuff that gets dressed up. So all the bad stuff that everyone won't like will be dressed up as if it's good stuff, or it gets delivered the bad news first and then it's countered with the good news, how this is all going to make UK great again, that sort of thing. So first and foremost, the market may react to the headlines that drop out, or at least at the end when everything's been delivered, the market might make an early judgment. Is this good news? Is this bad news? And will move accordingly. The secondary big risk for this is the OBR, the Office of Budget Responsibility. They're the independent body that prices it all up, says whether it's good or bad, says whether the numbers make sense and are achievable in terms of debt reduction and that sort of thing. Are they sustainable? They are one of the ones that caused some of the ripples after the trust Quartang stuff, because they came out and said, hang on a minute, that all sounds good, but it's going to cost you X, Y, Z. It's going to mean 100 extra billion of borrowing. That's what the market got its knickers in a twist about. Now, if the OBR give everything that's delivered today a green light, then that's when we're probably likely to get the bigger price move, and that'll be upwards in the pound. If they come out and say, no, it's absolutely rubbish still, it's still going to cost you a lot of money, or it's not going to have the desired effect, anything negative, we're going to see the opposite. Now, there has been a lot of meetings and stuff between the Chancellor and the OBR. They've been talking a lot. I would hazard a guess that despite them supposed to be being an independent body, these consultations may lead to something where the OBR is at least partially on board or doesn't see anything too risky from what's delivered today. So it could be a nothing burger event. But as I say, we know what the risk is. The risk is the initial move, what the market takes from it. The secondary risk is what the OBR says about it. And that's, if you're trading it, that's what you should base your trading on. Do I think we're going to get hundreds of pip moves from this? I don't think so, unless the OBR is really scathing or really on board with this. But even then, I'm not seeing big moves coming on this now that we've known a lot of the details.
Intertwined independence.
Sorry?
Intertwined independence.
Yes, interlocked independence, exactly. Now, thirdly, from all this will be what the market infers the Bank of England may do with it all. Now, if this is heading towards austerity 2.0, a lot of cutbacks in spending, a lot of tax hikes, then potentially that might put the Bank of England, or keep the Bank of England in its cautionary state of not having to raise as much as expected, because these measures will take further steam out of the economy. So that may draw down market expectations for BOE rate hikes, which is obviously potentially negative for the pound. Now, to just try and summarize that all up in the scope of today, what you need to look for in events like this is, what is the market doing going in? At the moment, the market is going in with a fairly strong dollar move today. So one thing you need to look at, if what comes from this stuff moves the pound or something like cable in the opposite direction of what everything else is doing, that's what you potentially need to look at for a trade, a fade. If dollar strength is continuing, but we see cable rising, then you've got to think, well, the dollar is going to win out overall at the end of it. Maybe that's a fade. If you get something up to 120, certainly be an area I'll be looking at for a possible fade if, excuse me, if dollar strength is maintained. So I hope that's given you a bit of insight into what I'm thinking from that, and how it may all pan out. Kay, Stel, you got anything different on that, or anything you want to add to that?
Yeah, I think we've heard already a lot of what they plan to do. As you say, they've been talking to OBR. OBR gave some numbers, if I recall well, 55 to 70 billion or so. range for the spend, or what was it, the rest of the spending, the 55 billion hole to
fill.
To fill. I would say it might be that we have seen the move already in big parts, because as I've said over the past, there's two parts to this. Yes, they are going to do austerity in a not nice economy with very high inflation. That is really not good at all. But then, if you look at it from a sanguine point of view, from the investor point of view, usually, if a country takes care of its finances, investors may actually like it, and I think that's what perhaps we've seen already. The reason why cable went up to 119.5 euro sterling, back to the support, for instance, and other sterling process holdings. So it's a bit of a double-edged sword here, in my opinion. But I think after the initial positiveness, we could see a bit of weakness creeping in. But then, yeah, and as you, I don't think it warrants several big figures of moves. But yeah, we know how fickle the market is, and especially lately in cable, being an emerging market currency, as some people say. It could move 200 points, but yeah, I think a lot of it is already known, and I'm not sure we're going to get really massive moves out of it.
Yeah, and I think it's the volatility that's going to do it. You know, I'm just looking at the 1 month at the money vols that I use as my rule of thumb for how volatile things are. Dollar yen is currently running at 12.7%. Euro dollar running at 11.87%. Cable running at 13.52%. So we still have this volatility premium in cable, if you like, which just means that it's going to move larger on potentially smaller news than it would do normally. So if vols were something like 7-8%, bad news might move it 20-30 pips. With a higher vol, that might be 50-60-80 pips. So the volatility is what's going to move things, even if the news isn't big. But yeah, this is cable. It can do 200 pips in minutes, depending on what the market wants to do. So from a risk perspective, no, that's the market you're trading in, and just take care. But yeah, hopefully we've given you a good idea of what to expect from this anyway, and how to trade it thus wise. And on that note, Nestel's got anything he wants to add to the UK stuff?
No, I don't, mate. Sorry.
No worries. No worries. We shall call that a day, because we're going to be tuning into this budget crap in the next 4 minutes. I'm not looking forward to it. A lot of waffling. Anyway, we'll find out on tomorrow's show what happened and what moves came about, and whether life is going to go on in the UK after today. So thank you very much for coming to the Flow Show, boys and girls. Have a safe trading day. See you all tomorrow. Thanks, Kay. Thanks, Dale.
Safe trading.
Thanks, Ryan.